Welcome to this explainer. If you've ever managed a global rollout for systems like SAP or Oracle, you're already well aware that every country has its own little quirks. But Poland? Well, Poland presents some incredibly unique, rigid challenges that can completely derail your deployment if you ignore them. Today, we're going to unpack the specific rules from the source material and figure out exactly what international businesses need to do to survive a Polish tax audit by flawlessly configuring their 2026 ERP localization. Let's dive in.
Here is our roadmap for today. We're going to cover 4 key areas. First, the Polish language mandate. Second, Polish legal entity types. Third, Class 4 versus Class 5 accounting. And finally, localizing your ERP system.
Okay, starting right off with Section 1, the Polish language mandate.
Picture this. You're setting up a regional accounting hub, and you decide to group all your Eastern European countries together into a single, streamlined software template. Makes sense, right? Well, treating Poland like its neighbors is actually a massive compliance trap. While countries like Lithuania, the Czech Republic, or Ukraine might allow Polish to just be recognized as a minority language alongside their own national reporting, Poland stands completely alone in its absolute rigidity here. The Polish language is the strictly mandated official language for all professional accounting. You simply cannot use a shared regional language setup or try to run your official ledgers in English just because headquarters prefers it. The local authorities flat out won't accept it. It is a fundamental operational requirement from day one.
And honestly, the 1994 Polish Accounting Act does not mess around on this front. It legally mandates that all accounting records and documentation have to be maintained in Polish, and all ledgers must be strictly balanced in the national currency, the Polish zloty. So here's a reality check for your IT and finance teams. Even if your global ERP instance runs entirely in English internally, your software's localized reporting engine absolutely must be capable of producing certified Polish terminology and PLN currency outputs on demand. Actually, handing an auditor a spreadsheet you just ran through Google Translate, that is a guaranteed way to fail a fiscal audit and trigger some pretty severe operational penalties. Your system's foundational architecture just has to respect these linguistic and currency rules natively.
Moving right along to Section 2, Polish legal entity types.
So understanding your legal entity is your next critical step, because this dictates the very foundation of your software's equity structure. For most medium to large international businesses entering the market, the spółka z o.o., which is essentially a limited liability company requiring a minimum of 5,000 PLN in capital, is going to be the foundational entity you configure. It's definitely the most common corporate vehicle, but if you're a larger publicly traded operation, you're going to need to configure the SA, or joint stock company, which demands a much higher capital minimum of 100,000 PLN. And hey, for agile startups, there is the newer PSA designation, requiring literally just a single zloty to get off the ground. You have to know exactly which bucket you fall into before you map a single account.
That entity choice totally dictates the architecture of your chart of accounts. When building your 2026 set of books, which, by the way, your system must officially label as księgi rachunkowe to be compliant, you have to map your equity directly to the Polish Group 8 or 800 series accounts. And listen, there is absolutely no room for creative translation or generic headquarters terminology here. Your registered share capital must be mapped precisely to account 801 and explicitly labeled kapital zakładowy. Your current year profit or loss hits account 860, wynik finansowy, and your supplementary capital needs to route to account 803, kapital zapasowy. If you use generic English equivalent labels here, it will immediately flag your system as non-compliant to a local auditor, and you'll be looking at a massive manual reconciliation effort.
All right, Section 3, Class 4 versus Class 5 accounting.
Now this right here is where Polish accounting gets incredibly unique and often gives international controllers a massive headache. It splits expense reporting into 2 distinct parallel philosophies, and most medium to large companies are legally required to run both of them simultaneously. On one hand, we have Class 4, which is expense by nature. This is your foundational statutory reporting that simply asks, what did you buy? Like mapping the purchase of raw materials directly to account 401 or wages to 404. On the other hand, there's Class 5, expense by function. This is deeper management accounting that asks, where in the business did this cost actually occur? Did it happen on the factory floor hitting account 501 or in the back office under administration in 550? Your ERP literally has to handle both realities at once.
So you're probably wondering, how on earth do your IT architects run Class 4 and Class 5 simultaneously without accidentally double counting all of your expenses and totally ruining your profit and loss statements? Enter Account 490. It acts as a mandatory mathematical bridge. Think of it as a special clearing account that ensures your books balance perfectly in real time, matching the nature of a transaction to its functional destination. When a cost is incurred, it hits Class 4, flows seamlessly through Account 490, and lands right in Class 5. It is a fascinating piece of accounting logic, but your ERP system must be custom programmed to clear these ledgers flawlessly at month end. You absolutely cannot rely on manual journal entries for this volume of data.
And that brings us to our final stop, Section 4, localizing your ERP system.
Let's get right into the database weeds, because you definitely do not want to fail a multi-million-dollar fiscal audit over a silly formatting typo. First, ensure your database perfectly maps the ISO 4217 currency code to PLN, with the official currency name set to zloty. And here is a remarkably common trap that catches so many foreign configuration teams. The currency symbol ZL must always be lowercase, and it must be configured to appear strictly after the numeric amount. So, 100 zloty. If you put it before the number, you will break local invoicing formats. And finally, don't forget the minor unit. Instead of cents, your system's decimal logic has to accurately calculate, round, and display the grosz, symbolized as GR.
Now, here is a magic number your system must be hard-coded to recognize instantly: 15,000 PLN. If a business-to-business invoice hits or exceeds this exact amount, your ERP system must be smart enough to automatically trigger the Polish split payment mechanism, known locally as MPP. Basically, this law requires your software to automatically divide the payment, diverting the VAT portion into a dedicated, ring-fenced bank account that the business cannot freely access. If your software misses this trigger and just pays the total gross amount to a standard vendor account, your company will face immediate, severe financial penalties and joint tax liability. Your accounts payable module just has to be flawlessly configured for MPP.
Looking towards 2026, paper and generic reports are completely dead. Electronic reporting is the absolute, uncompromising standard for Polish authorities. Your system's output labels need to abandon lazy, translated terms like tax report or audit file. Instead, your user interface and extraction tools must specifically generate and reference JPK files, which stands for Jednolity Plik Kontrolny. Depending on your business's revenue size and filing frequency, your system has to export the JPK_V7M for monthly reporting or the JPK_V7K for quarterly. Your local Polish accounts are going to be searching your system specifically for these exact acronyms, and if your ERP can't generate them natively, your deployment simply isn't ready.
Finally, let's talk about the incredible danger of cutting corners with interface localization. If you just hand your standard English interface to a generic translator, they might literally translate the word debtors into dłużnicy. In a professional Polish ERP environment, this is considered highly amateur, confusing, and honestly just unacceptable to local finance teams. You have to use academically approved accounting terminology. For your balance sheet outputs, debtors should be mapped to the formal term należności. And for the software's everyday user interface and subledgers, you should configure the term rozrachunki z odbiorcami. This granular attention to detail is what ensures your software aligns perfectly with the strict expectations of local professionals and tax authorities.
So from the absolute strictness of the Polish language mandate all the way down to the granular mathematical bridges of Account 490, I hope it's abundantly clear that Polish localization is vastly more complex than just installing a simple language pack. It is a giant puzzle requiring deep structural alignment with local tax laws, complex accounting structures, and technical reporting standards. So I'll leave you with this provocative thought. After seeing the sheer rigidity of these legal and technical requirements, is your 2026 global ERP template genuinely ready for Poland? Or are you just hoping the auditors won't look too closely? Thanks for joining me on this explainer, and I hope this provided the clarity you need to move forward with total confidence.